Welcome to the deep dive.
Great to be here.
Today, we're jumping right into a major auto retailer's Q2 performance for fiscal year 2026. Specifically, we're looking at the CEO's strategic update from the earnings call.
Yeah, it's a really interesting one. We're focusing just on those opening remarks from the CEO.
Right, because you've got this situation where they admit things didn't go as planned in Q2, but they're also laying out this, well, pretty aggressive long-term growth plan.
Exactly. Our goal here is to unpack that. How do they square the short-term challenges they faced with aiming for things like high-teen EPS growth and mid-single-digit retail unit growth?
That's the core question. How do they plan to bridge that gap?
It's quite the ambition, especially after a tough quarter.
Okay, so let's start with Q2 itself, the results.
Well, they weren't great,
No, definitely soft. Total sales hit $6.6 billion.
which was down 6% compared to last year, and the key metric, used unit comps.
Also down 6.3%. That really tells you about their core market performance.
But it's not just the decline, it's why it declined. That's fascinating. Right. The CEO pointed directly at the fallout from earlier tariff speculation.
Okay, what does that mean exactly? For you listening, basically there was fear about potential tariffs on imports.
Yeah, tariffs that could have pushed up the cost of getting certain vehicles or parts. So management, thinking ahead, decided to really boost their inventory levels before Q2 started.
So they basically stocked up betting on these tariffs.
It never actually happened.
And the timing was, well, pretty bad. They ended up with way too much inventory, just as the market seemed to be cooling off a bit.
Exactly. It created this sort of double whammy mid-quarter. First, all that extra inventory started losing value. We're talking about roughly $1,000 per unit in depreciation cost between late May and the end of June.
Wow.
Yeah. And that just killed their price competitiveness right away.
And the second hit.
The second hit was demand. They believe some customer buying got pulled into the first quarter, leaving Q2 feeling pretty weak on the consumer side.
So too much inventory, falling values, and softer demand. Not a good mix.
Definitely not. And you see it reflected in the pricing. The average selling price dipped to $26,000.
Which is down about $250 per unit compared to the year before.
And interestingly, you saw a shift in what was selling. Performance struggled with the newer, 0 to 5-year-old cars.
The prime inventory.
Right. But that dip was partly offset because they actually sold more of the older, higher mileage vehicles.
Huh. That really suggests consumers were hunting for value, maybe feeling the pinch from interest rates or inflation, trading down.
I think that's a fair read. People were looking for affordability, even while the retailer was dealing with this glut of higher value depreciating stock.
Shows how sensitive the market is right now.
Absolutely. And because things got so tough on pricing, the company had to react fast.
So what was the immediate fix? How did they try to stabilize things?
Well, the response was pretty aggressive, actually. They deliberately cut their retail margins.
To push sales through.
Exactly, to get volume moving again. And at the same time, they really slowed down their vehicle buying to try and get inventory back in line with sales.
They needed to rebalance, basically.
Right, get the warehouse right-sized, even if it hurt.
And that hurt showed up in the margins, didn't it? Retail gross profit per used unit.
Yeah.
It was similar year over year, which sounds okay on the surface.
But the key number, the really telling one, is the sequential change. From Q1 to Q2, that profit per unit dropped by approximately $200.
$200 down from just the previous quarter.
Yeah, and that number is critical because it was more than double their usual historical drop between Q1 and Q2.
Wow. Okay. So that really highlights how severe the correction was.
It absolutely does. Think about that. It shows just how big the inventory miscalculation was and how much margin they were willing to sacrifice to fix it. It wasn't a small adjustment. It was a major move to get competitive on price again and clean things up for Q3.
You have to wonder, though, does that suggest more than just misreading tariffs? Maybe overestimating their ability to manage that much inventory?
That's definitely the underlying tension here, isn't it? The CEO frames it as a necessary response to market conditions.
And did it work? Did they get things back on track?
According to the CEO, yes. He stated the strategy was effective. They improved their price competitiveness, got the inventory into a much healthier spot, and felt better positioned heading into the third quarter. A painful reset, but maybe a necessary one.
Okay, let's touch on the operational side of that cleanup. Vehicle purchasing.
They bought 293,000 vehicles overall, which was down slightly, about 2% year over year.
But that wasn't because they couldn't find cars, right?
No. It was a deliberate choice. They actively pulled back on offers to consumers. They still bought a lot from consumers, 262,000, actually. more than half online. But the reduction was intentional to manage that overstock situation.
Got it. And they expect that buying activity to pick up again.
Yeah, they're forecasting year-over-year improvement in buying for Q3, suggesting they feel the inventory correction is largely done.
And what about their other business lines like wholesale?
That actually held up pretty well. Wholesale unit sales were down a little, 2.2%, but the profit per wholesale unit was strong, similar to last year. So that diversification helped cushion the blow a bit.
Okay, so Q2 was about reacting, correcting, taking the hit. Now let's shift gears. The CEO spent a lot of time looking forward, laying out the plan to avoid this again and hit those big growth targets.
Exactly. This is where they move from defense to offense. He outlined 4 key strategic pillars.
The foundation for the future, essentially.
Right. Built to drive market share over the next 18 months and support that long-term earnings model.
Let's take them one by one. Pillar 1 seems to directly address the Q2 pain point, price and selection.
Yes. Pillar 1, price and selection. The big lesson clearly is agility. They need to maintain competitive prices but also shield themselves better from macro shocks.
So smarter buying, better inventory management.
Pretty much. Faster turns, more efficiency, making sure they have the right cars, meeting their quality standards, but without getting caught holding too much inventory again.
Makes sense. Okay, Pillar 2 moves to the customer side.
Pillar 2, consumer awareness. This is all about getting noticed and making sure people understand their offering, especially the omni-channel experience.
And the big push here is a new ad campaign.
Yeah, they've launched Wanna Drive. The CEO stressed, this isn't just fluff, it's strategic. It's designed to improve what they call the conversion waterfall.
Okay, unpack that for us. Conversion waterfall.
Basically, it's the journey a customer takes from, first seeing an ad or visiting the website all the way through researching, and then finally deciding to actually buy or sell a car with them.
So the campaign aims to make each step more effective, get more people from looking to actually transacting.
Exactly. They need that marketing spend to translate into real sales and acquisitions.
All right. Pillar 3 gets into the nuts and bolts, the finances, cost cutting.
Yes. Pillar 3, SG&A reductions. This is a big one. They've committed to finding at least $150 million in incremental SG&A savings over the next 18 months.
$150 million. That's a significant target. Where's that coming from?
The plan hinges heavily on technology and AI, streamlining logistics, automating processes, using tech to make employees more efficient.
So efficiency gains, not just, say, headcount reduction.
That seems to be the focus. And they believe they can do this while improving the customer experience. They want to hit new highs in their Net Promoter Score, their NPS.
And didn't the CEO mention their NPS score is already strong?
He did. He highlighted that it's currently the highest it's been since they rolled out all their digital tools nationwide, especially high satisfaction among those online and omni-channel customers.
So the bet is technology drives both customer happiness and cost savings.
That's the plan, which leads logically to the final pillar.
Pillar 4.
Pillar 4, diversified business profit. This is about squeezing more profit from areas beyond just selling the cars themselves.
Okay, and the main engine for that?
It's primarily their finance arm, CarMax Auto Finance, or CAF. The goal is to increase CAF penetration, get more customers financing through them, and boost its profitability.
Makes sense. In a shaky market, a strong finance arm can provide a buffer, right?
Absolutely. If retail margins get tight because of price competition, doing well on the financing side offers a crucial counterbalance. Of course, they stress doing this responsibly, balancing growth with smart lending.
So you put these 4 pillars together: smarter pricing and inventory, better marketing reach, huge cost efficiencies, and optimizing finance.
And they all funnel towards that single big goal the CEO laid out.
Which is
that ambitious long-term model, high-teen EPS growth, combined with mid-single-digit retail unit growth.
quite the target.
It is. And the CEO kept emphasizing that these actions, especially those SG&A savings, are designed to give them flexibility and make the company stronger, ready to hit those goals even if the market stays volatile.
That $150 million in savings really feels like the linchpin, doesn't it? Funding the marketing, providing pricing flexibility.
It seems absolutely critical. They're trying to become leaner internally so they could be more aggressive externally in advertising, in pricing when needed, and in advancing their tech.
Which really brings us to the final question, the thing for you listening to think about. They're promising this really strong earnings growth right after a quarter marked by, frankly, a significant inventory mistake and a big margin hit.
Yeah, the contrast is stark.
So, considering they need to stay nimble on pricing, as the CEO put it, and they're ramping up spending on this big Wanna Drive campaign, will that promised $150 million in efficiency gains actually be incremental profit? Or will most of it essentially get eaten up just covering the higher marketing costs and any price concessions needed to win market share in this environment?
That really is the crux of it, isn't it? Can the savings truly boost the bottom line significantly, or are they primarily just funding the growth strategy itself?
Yeah.
That's the big question mark hanging over those long-term targets.